you all doing? Just gonna get straight into it today. None of the waffle that was the beginning of the last video. Just gonna quickly finish off on this Helen of Troy, which we were looking at in the last video. Basically, I'm just gonna move on from it, I think, because it's just, I don't know. I don't particularly see personally any value in it. Yes, I get that it's trading at a significant discount to revenues. Simple free cash flow yield's pretty good, but historically, when you look at the multiple, all right, yeah, it's heavily drawn down by this one bad year where they had an acquisition in 2022. We go to here, 2022. Where am I looking? Cash flow, isn't it down there? I think. Acquisitions there. So that's made an acquisition in 2022, which significantly harmed free cash flow for that year, which is why the multiples dropped off massively. But 9 times, 10 times, 4 times, you know, to me, it seems like currently it's, if anything, potentially overvalued. I know that the return on capital has been significantly hampered by the fact that they've had to write off some goodwill on the income statement. So obviously that's hampered the EBIT part of that. But like I said, from a multiples perspective, it doesn't look overly cheap. The return on capital is slightly improved. It's still way below historic averages. What have we got when we go back further back? See, all bright green, and currently dull green, above 10% dull green. It's just not something that I'm particularly interested in, I don't think. So I think I'm just going to move on from it. You know, yeah, we spent a bit more time on that. It didn't say no as fast as I was saying that we should be saying no yesterday, but it is what it is. We did a little bit of research. We learned a bit. I learned a bit. That's the main thing. But yeah, I'm just going to move on from this one. It's not enough in it for me, really. Like I said, just purely based on the multiple basis, really, and the enterprise value. I know it's a rolling credit facility by the look of it, so it's not, it's not debt that effectively needs to be paid by maturity. Obviously, it does, but it's probably likely to get renegotiated, so it's not too much of an issue debt-wise. They are making reasonable amount of free cash, 100 million, 200 million. 2022, that was when the acquisition was. I don't know, it's not a bad business. It's just not, it just doesn't look cheap to me. When you look at the price of where it was, to be trading at, what was that then, 2021 into 2022. So if we look on the spreadsheet, 2021 into 2022, at that point it was trading at 32 times simple free cash flow, which is nuts compared to, I don't really know what caused that. I guess it was probably a post-COVID run up where everything went a little bit mad. But to me, there's nothing else there worth really spending the time on. So I think what we'll just do, get back up and go straight back down the insider purchase list. And then some of these I'll potentially look at, some of them I potentially won't. I said I'll put it into here. This is where I'll put it into. See where anything comes up. But like I said, I'm going to run this off screen just so we can go through it faster. So SSGC, if it's interesting, I'll drag it back on screen and show you. So no, Old Market Capital Group, OMCC. So there's not enough data with this one. That can't be a very old company. Let's have a look. OMCC. Yeah, there we go. I want to have historical data. I'm not really someone who will invest in new companies. I don't know why I'm saying invest, because I haven't done it yet. I haven't built a portfolio. I'm not somebody who likes the idea of investing in brand new companies. I want more data. I want more background into the company than that. And as you can see, when I drag this up here, we get past that. There's no data, and what we have got, red. Obviously, that looks blue, which is really good, but that's because it's negative, and that's only negative because these are negative, so it's not actually a good thing, them being blue in that case. So just going to move on from that one as well. REEX, what do they do then? So this doesn't look too bad. Exploration of oil from the, what's that going to be, Permian Basin then, I take it. Independent oil and natural gas company engages in acquisition, exploration, development, and production of oil, natural gas, and natural liquids in Texas and New Mexico. San Andreas Formation. All right. So there's some things that pop up there. Return on capital is all right. It's a very capital intensive business, the oil industry. What have we got here? Where am I looking? Simple free cash flows grown a lot. It's very high this year actually compared to previous years. So we could dig into that and see why. EBIT, operating income, looks all right. So, and this, we like this to see that the company could potentially buy itself back very quickly. Market cap of, $500 million, so reasonable size. Enterprise value is not too much over as well. Currently selling almost for bang on tangible booklet. So, if anything, I suppose it would have to be a cash flow play. So let's get that one into the main spreadsheet, and we'll have a look, and we'll just open it up on, where was it there? See how many people have bought recently. There's been a few this year. One thing I learned from watching Roaring Kitty's videos is that you can't rely too much on the fact that there's a lot of red there, a lot of selling, because people tend to sell for any multitude of reasons. There's only generally one reason why they buy, and that's because they believe it to be undervalued. So, there's been a few this year, one very recently, obviously that's why it's just shown up. So, it's not an insignificant amount of money. That one wouldn't have even been worth looking at, but that one there again, not an insignificant amount of money. Down here, look, 2 million. When was that? Last year, early last year. So let's drag it into the spreadsheet. Let's get it up here. Have a look at the chart. Saying I'm a fundamental investor and then starting on the chart. We got here then, because that's quite an interesting, pardon me, quite an interesting channel there. Look, definitely got some historical significance. I would say it's there because you've got, what would you call it? Price action working around the center line there. So I'd imagine that is the channel. This has just gone way outside it for some reason in 2022. It's definitely got seem to have a significant price floor there as well. On the broader scheme of things, down there, look. So from a technical analysis point of view now, you'd be looking at what it would be from top to bottom. Say the trend is your friend until the bend at the end, then you would probably be looking to see what that is. 50% margin technically, right? This is just technically, which is obviously hoodoo to a lot of people. And it's not, I would never ever invest solely relying on technicals. Just wouldn't do it at all. Fundamentals are the absolute underlying reason for a trade. So let's have a little bit of a dive into this one. What was it? REPX. REPX. So, right. Close out Helena Troy. That's just my Z double prime calculation there. Right, Y sheets, quarterly data, REPX, show up. Called Riley Exploration. That not showing up then. Not good, is it, when we want to do? Yeah, we haven't got it on here. RE. Going up at all now. Miss, what have we got going on here then? Is it a internet problem? Not going well, is it? They must have the data because it comes up here. So let's just put the ticker in and see. One quick way, look, we'll do this. Income statement, net income, 28 million. Let's just check that it is the correct one. REPX against Yahoo's financials, and we'll see. Financial analysis, where were we? Net income, this is TTM, not on quarterly. 28. So yeah, it's got to be the right one. Total revenue of 102 million. 102. Yeah, this is it. So they do have the data. For some reason, it just wasn't showing up in the drop-down bar there. So let's get this in the spreadsheet. Copy and paste in, as rookie as it looks. That it's the most efficient way that I can currently do it. I live right out in the sticks, so the internet around here is not the best. So main metrics, let's see what we've got. So simple free cash flow margin of 28%, above 20 goes blue. All right, what have we got then? It looks like they run a negative working capital business, I would imagine. The current ratio is negative, so book value $25, tangible book's exactly the same, which is good. It means that there's likely no goodwill or much goodwill or intangible assets on the book, whereas the goodwill and intangible assets, they're saying none. Let's just check that against Yahoo Finance just to see if there's anything on here. Not that I see. Could be in the assets anyway. I don't know why I even scrolled down that far. Rookie error again, see? So no, it doesn't look like they've got anything, so that's good. So from a proxy liquidation value, you're there. Interest coverage, very good. They got enough cash to pay their interest for the next 5 years. Net current assets a share, negative. Cash 42 cents a share. Dividends, they pay a dividend. $1.50. So again, I'm sure I read or heard Ron and Kitty say that dividends would trade for up to about 20 times. $1.50 times 20, $30. So not a lot of upside on that, should there be. EBIT more than covers interest expense, earnings pretty good. Simple free cash flow 5, 4. It's gone through, like, it's skyrocketed in recent years. How old's the business then? Let's have a look. Been about for a while, a long time. Early 2000s on here. This here is the very beginning. So in the 90s, it's been about a long time. Look how it's COVID, yeah. We've really got in at $6 on COVID. Look it up, even if you took it up to the part of that, 400% in less than a year. Wow. That would have been an investment, wouldn't it? Shame I was not even remotely in the game at that point. All right, let's get back to it. So Bruce Greenwald's simple free cash flow from his earning power value is given out similar per share to my simple free cash flow one. Return on capital 16%, 12%. So yield of 15%. You know, looks like a reasonable business, doesn't it? 118, 81, 15. I want to know what caused this then, because revenues, no, they obviously done something at the point. Go from nothing to all this, the revenues. Let's ask ChatGPT. Get on with it. REPX Riley Exploration Inc. What is the business do they want? See what they say. Pretty obvious, it's another exploration company. Core business acquires and develops acreage in the Permian Basin, focusing on conventional oil saturated formations like San Andreas Formation. They employ horizontal drilling, advanced technology, revenue streams, oil sales, dominant production growth. Organic development drives 85% of volume growth. Acquisitions add a remainder 15%. So they have acquired some stuff. Early 2025, RepX announced the acquisition of Silverback Exploration for 142 million. Okay, joint ventures, contract services, how they make money, selling oil, natural gas, very obvious. Didn't really need to ask that question, did we? Generating power, ancillary services. So what has caused the growth? Do they have as well? Let's have a look. Long-term debt. What sort of debt is it there? 200 million. Gone up significantly. Look. And the short-term debt's gone up significantly. Wait. Let us SEC RepX. Look at all that, what insiders own a minute. That's always worth looking at. You want companies that are people that working in it believe in the company. You know, if their own skin is not in the game, is it worth investing in it? You know, because they're not aligned with you. If you lose money, it makes no difference to them. You want people that are in it for you. You know, greed is a Gordon Gekko. Greed is good, but if they haven't got skin in the game, I don't. You know, it doesn't matter to them if the stock tanks. It does matter to them if they own it. You know, 4.7% down here. Directors and executives own 4.7%. It's not a high amount, to be honest. Generally, you will find businesses that are much higher than that. Sign me out again. Why does it keep signing me out? Hang on, let's sort this out. Don't remember my password again. Screen. Right. REPX, percent of portfolio. So these are the people that really believe in it. Got a few with significant ownerships in it, and they actually own an awful lot of the company as well. Yorktown Energy Partners, who are they? Largest holding is Riley. Yorktown Energy Partners. Based in New York. It's an energy-focused private equity firm that targets consistent returns across multiple subsectors of energy. With 3 decades of experience investing across the evolving energy landscape, we seek to support 3 decades, 30 years old. Right. Okay. Manufacturing services, metals and mining, renewables, oil and gas. Ontario, that was a big trade around COVID, I believe. I'm pretty sure that's one that Roaring Kitty spoke about. Okay. Alright, so they're just a private equity firm that likes energy. They're going to be the same then, aren't they? Bluescape Energy Partners. Bluescape Energy. Alternative investment firm, yeah. Okay. They're heavy into this. Estimated average prices are around about what they are now. Anybody else? In a portfolio? No, not really. Ownership. Vanguard, BlackRock. State Street's down here. There you go. Usual suspects then, apart from those at the top. Okay. What is the dividend yield? Let's have a look. So over the last 0.36, graphic calculator out here, not that you can see. 0.36 38 plus 5, maybe I shouldn't have counted one of them. 38. No, this one's not happened yet, so we're not going to count that one. Okay, so yes, $1.50, that is correct. $1.50. The share price 26.5, just under 6% dividend, which is not too bad. Obviously, you'd have to add that if you were to invest and make some money on it. You'd have to invest add the return of dividend onto your return as well. So that's not too bad. Let's see. And about REP. Strong buy. May. Buy. Strong buy. Premium pure play with strong production growth, 5.7% dividend yield, and a compelling valuation at 4.6 price to earnings. Strategic acquisitions, infrastructure investments. It's going to be very difficult when you see the growth in revenue to use a multiple on that, isn't it? Because to go from 61 million to, nigh on half a billion. Multiples are wildly changed, haven't they? See what they got to say. Strategic acquisitions and infrastructure investments, like Silverback 2 deal and New Mexico gas pipeline, will unlock production and boost long-term earnings. Okay. Managers focus on acquiring undervalued asset and building reserves. Appreciation, investment thesis. Here we go. Straight to the crux of it. Premium pure play of a 60/40 oil gas split for production. Output of 26.4. At a midpoint, 70% increase year over year. Okay. drilling more, obviously your revenues is going to go up then as well if you can sell it, which obviously you will be able to. Dumb thing to say. On our first coverage of Repex's first entrance into New Mexico, a year later the price has fallen 9.14% despite a dividend increase, continued free cash generation, strong production growth. How much is the dividend increase then? Where are we there? Oh yeah, it has. Not hugely. It's around about what it was. Right. Slight dividend increase, continued generation, strong production. Management is emphasising filling out architectural gaps in power and gas takeaway, as well as shoring up undeveloped reserves. Gas takeaway pipeline to connect, increase realizations over the long term. Addition is expanding its gas generator operation to New Mexico, which has reduced its cost in Texas now, covering 50% of 6% of power needs. So that's pretty good. Also purchased new undeveloped reserves in the form of Silverback 2, adding around 43,000 acres of land. We believe that historically strong growth in production and focus on building out acreage in its current cost profile on top of 5.7% dividend yield provides a compelling buy for investors over the long term. So, on them, just on dividends alone, if they could keep it, not that we know that, not that we can forecast that, 1 divided by 0.06. 16 years you'd have to hold it for just for the dividends to pay you back at this price. Estimated fair value, earnings per share. So we believe New Mexico gas pipe at $53. Wow. Going to break that down or not, or is he just going to say this is what we believe? We believe that the New Mexico gas pipeline associated 15-year gas supply deal will boost realizations in the Yeso formation. Additionally, the acquisition of Silverback 2 acreage provides strong development locations at the current cost profile. Combined, these should boost earnings power over the medium term. While we do expect some short-term pressure from weaker pricing, REPX is 6% of oil production hedged and 85% of gas production hedged for 2025. What's that? West Texas, isn't it? WTI. I'd imagine in America they're going to go from $7 a barrel. Looks like we've got another level down there that historically $60. Way down. Thing is that they're going to drill more. It's going to negatively affect the price, isn't it? Wouldn't even hazard a guess at this as to where go. Maybe there. This is the problem with technical analysis, though. It can be guesswork. Touched. Potentially there. I mean, if it's a healthy trend, it's going to go down lower. Should do. Right, all guesswork. So let's get back to where we were. 6.8 times fair value. Estimated earnings per share 2027. They got this estimated earnings per share from. That's something that they have put out. Let's have a look. REPX. Where is it? Riley. Investor. Quarterly dividend schedules. Premium announces closing of New Mexico acquisition. That one that didn't work out. It is previously announced acquisition of Silver. Oh, sorry. Not closing. What an idiot. They've closed the deal on the acquisition. That's what that means. What an idiot. Annual meeting, premium reports, first quarter 2025 results, announces acquisition, modified development outlook, latest presentations. Got on here because looking at it. Yes, it is. Is ask ChatGPT, where can I find REPX future earnings estimate? They've got that from somewhere. 2020 year 2027. Wall Street Journal. Other analysts. So have they not tipped it themselves? They released it. So human has not provided its own forward-looking earnings per share estimates in recent press releases, while the company regularly issues guidance covering production growth targets, capital expenditure budgets, reserve assumptions, and midterm. It does not typically forecast. Right. Total production growth, and maybe they're getting it from that of 9 to 14% if they've done that. 27. Current PE. Getting in a bit of guesswork now, see, this is a problem. On EBIT. Cash flows around 7. I haven't actually got the earnings multiple in the spreadsheet. Earnings, yeah, I do there. 7 on enterprise value and 0.4 on market cap. Okay. Historically, not going to be looking at a multiple, particularly high multiple, are you? I know that is ridiculous. But in recent years, 4s and 5s. So we believe that New Mexico gas pipeline associated 15-year gas supply will boost realizations in the, probably read this already. Additionally, the acquisition of Silverback, yeah. Well, we do expect some shortage. Yeah, we've read that. Okay. Estimated price to sales, price to earnings. Am I going far enough here? Maybe they've not. During a quarter end in March, production averaged 63.9% of oil. So, okay, yeah. Breakdown. In line with historical averages. Revenues 96% oil. Improved realizations. The Western Part Repex is building 120 million pipeline. Also entered into a 15-year natural gas supply agreement with a large cap midstream partner, which we also believe is Targa. No idea what Targa is. Must be a business. Pipeline is estimated to be completed before the end of 2026, with construction beginning during the quarter end in March 2025. While we do not expect natural gas to become a large portion of the revenue, it does unlock the ability to pump more oil. Okay. Now to be purchasing Silverback 2, 52% oil production. The development of the asset will initially focus on the east end. Okay. About that, you want to know where you're getting your projections from. Other projects. Production outlook, maybe we're down here. But around 10 to 15 net wells to come online during the year. This would be a decrease compared to 24's 19, 2023's 18. Management did not comment that it's reducing capex overall and focuses on the acquisition and preservation of high quality inventory. So it basically not going to try and reduce capex. If you don't comment on it, then it's not something they're focusing on, is it? Right, so they don't say where at any point where they get that from. Despite depressed prices in global energy markets, management had an average realised price during the quarter of $50 a barrel. And we expect to come down marginally during the year, second half of the year, as low strike prices on hedges for oil. Right, unhedged come here. So $50 a barrel range. So they essentially then realised prices are adjusted for derivative gains. The lower than it, so for new rigs, management expects LOE to come down towards historical average around 8 BOE. What's that? BOE. They up here? Range. See, we're learning. I ain't got a clue. BOE. BOE. Where's the first time it's mentioned there? Okay. Let's see if ChatGPT knows. What does BOE mean when talking about oil duration? Barrel of oil equivalent. Oh, I think I did know that. Right, okay. Management expects the LOE. So what's the LOE? Ugh, come on. What does LOE mean in the same context? Lease operating expenses, right? Essentially. Historical average. Okay, yeah. So that makes sense in the context of what they're talking about, so that probably is correct. G&A increased during the first quarter of the year due to increased headcount and legal. Well, if they're up in, then yes, it would do, like up in scale. Lower than expected typical cost for lateral drilling at only around 600 feet, with Midland peers clocking around $400 to $1,000 per feet. Okay. Wow, that's about average then, isn't it? Across the full company, RepX reports its breakdown is on the lower half of its peers. Upstream capex is expected to be 75 million at midpoint, with 81% going. So they've done some pretty in-depth analysis on this. Look, right, during 2024, management reinvested 44% of cash from operations into exploration, 56% being converted into upstream free cash, 35% going into free cash flow. That's one thing I did want to look at actually. How has their cash position grown? Okay, cash at the end of the period. I mean, it's grown significantly since back here. In recent years, we're sort of basically around about average. Back to what we were reading. Even with the acquisition, we believe the dividend is more than safe. As of the quarter end in March 2025, RepX had a trailing 12-month net debt to EBITDA of 0.9. This number could climb as high as 1.3. There's specific financing in terms of the acquisition are not yet public. Maintains a borrowing capacity of 400 million over the medium term. New borrower reducing assets could potentially allow for larger borrowing capacity. Conclusion. Okay. Despite management cutting capex and targeting fewer well completions in 2025, production is still expected to decline by 17.3% year over year, which should boost revenues despite softer realizations. Despite these softer realizations through 2026, RepX has a mid-$30 break even, which may come down even further as power projects begin to reduce cash costs. So I'm guessing that's $30 per barrel, a break-even point. On the acquisition side, the strategy appears to be concentrated on acquiring assets that private operate. While acquisition will increase the debt burden, we believe that is low cost. High productivity well should provide for a fast repayment back on the 1x debt to EBITDA range. Management's strong focus on shareholder returns with 5.7% dividend yield and strong free cash conversion. Thus, we believe that Repex is an attractive stock for dividend investors in the short term, potential for capital appreciation over the long term. So, on the one hand, right, they're saying that it's good from a dividend perspective. And then, but up here, they're stating that in 2027, you could have more than a double, which, what's that, 18 months? That'd be a hell of a return, for 18 months. But I don't really know where they're getting their figures from. What did they say here? Production is expected to climb by 17.3%. So revenue for the quarter. I'm just seeing if it says anything about revenue growth in line with that. Should boost revenues despite softer realizations. All right. You want this other, because everybody's quite. No comments on that one. Look of it, elephant. Riley announced 142 million acquisition. Okay, yeah. Silverback acquisition, we've learned about that. I now estimate Riley's value between $32 to $33 per share at long term after 2026. $70 for WTI oil. This is a reduction from my early $38 per share estimate, which was done using $75 a barrel for WTI as a long-term price. This is the thing, isn't it? If you're going to keep drilling, there's going to be more oil available, which means the price is going to drop. Supply and demand. Sorry, I'm just having a drink a second. Talking about the acquisition. Riley's gained around 47 yet, we know that. Silverback assets. Know that. Reduced development plans. Riley expects to eventually pay a total of $130 million after purchase price adjustments. Okay. Also significantly reduced its midstream capex budget by 71%, dropping from $70 million down to $20 million as it pushes out much of that spending into 2026. Now expects around $111 million in total investments in 2025, 47% reduction from its original $210 million budget. Riley's lower capex budget is expected to result in 2025 standalone total production around 3% lower. Updated outlook. Here we go. So second half 2025 production around 28,000 barrel of oil, was it equivalent per day, including 17,350 barrels per day of oil production. So what is this then for the year? Current strip 25 includes these for production of 397 million in revenues for Riley before hedges. Okay, so what are we on now? It's over 400 million now, isn't it? And revenue decrease. The first time in years, look. Go down very well. Results in a projection of 109 million in free cash flow for Riley in 2025. There was workings, production expenses, total expenditures 302 million. Riley started with 2025 267 million in net debt. It's now projected to end 2025 with 321 in net debt after factoring in the Silverback acquisition. Riley's projected leverage at the end of 2025 is now 1.2, and it should be able to reduce its leverage below 1 during 2026 if it doesn't make additional acquisitions. I previously estimated Riley's value at around $38 per share in the long term, $75 based on $75 WTI. What was reduced the estimate to $32. This is based on long term after 26, $70 okay, $70 WTI oil. Difference in value is largely attributed to a $5 reduction in my long-term oil prices. Conclusion: Riley made a couple of significant moves amidst weaker oil prices. I made a 142 million acquisition. It gives it a large amount of future development potential. Riley has also reduced near-term development. Estimate Riley's value between 32 to 33. Any comments? Thanks for the update. Helpful. Right. What is then? This is going to be quite difficult actually, because you're not going to get a 7-year free cash flow margin to make any sense historically, because the huge difference in revenues. We'll do it anyway because we're only using a portion of it. 12 already done anyway. So what are we going to estimate future revenues at? They're estimating it lower. Well, one's estimating it lower. One's saying that there could be an increase in production of 17%, which you would assume would also keep revenues very similar. Where were we? So which one did we just read? That guy. 2025. Debt ratio is conservative. Dividend, therefore, has some advantages over upstream companies. Last article noted, okay, conventional opportunity. Come on, get to the numbers because we've read a lot about that now. Break even, debt ratio well within acceptable levels. Power generation, midstream project, large insider holdings. There are, yeah, not from the management, but there definitely are people highly invested in this from other fund perspective. Because of the large insider ownership shown above, the stock float and liquidity would actually match up with a much smaller company than the one would normally imagine. That's true, because if they're not selling it, then that stock's tied up. There's also additional consideration. This company has attracted a fair amount of attention despite small amount of stock float. Should one of those insiders decide to sell, it could take some time for them to exit their position. Yep. Relatively new issue of management that has built and sold companies before. That makes me this issue a bit less risky. Yield of the common stock is very attractive. Upstream company yields are often subject to conditions of market for product sales. Value is a bit hard to tell, as the company like this tends to grow the business and then sell the company when the prevailing business atmosphere is such that they can get a good price. Okay. That must be a statement based off of previous experience, because so far we've not read anything to suggest that. But this article was written with the idea that the threat of tariffs and trade wars are a bargaining situation that will be replaced with something predictable, constructive, and permanent. There's no assurance that that will happen. The company is entering new lines of business. Any upstream company is subject to volatility and low visibility of the future commodity prices. Right, okay. So they're $70 when looking for it to stay around here, which historically look. And that's staying within a range, but you still got a $10 range there. What is the long WTI price forecast? US Energy Information Administration, $65 a barrel in 2025, 55 BBL. Okay, barrel. I told you I'm a rookie. I don't know nothing. See long-term equilibrium oil price between 50 and 60 for 2024. Wow. Don't know who this is. I mean, that is completely at odds with this one. Where's that coming from? Goldman Sachs. What's Goldman stating? $55 in 2026. So you're definitely going to see a revenue drop, even if you're going to get an increase in production. I mean, it's pretty obvious, isn't it? Like, the new US administration wants to drill more oil, oversupply, lower prices. It just is what it is at the end of the day when it comes to that. Petrol prices in the UK, though, we probably won't see a drop in them. Technical and independent forecast, mixed predictions, trade union projects 28, WTI only reaching 28 to 29. Brent similarly, if you hover around 70 to 85 in mid 2000s, then drift lower. Okay, wow. Not look good long term for oil on the estimates. Most term models around the $50 to $80. That's what. Averaging 60 to 70 with downside risk if demand weakens or OPEC shifts gears. Well, 60 to 70 average, here you go. 59, 72. So, I mean, we're going to see. Pardon me, Theory B. We're going to see some revenue drops then, aren't we? Ultimately, dollars are going to come down here. Previous low, look. Another one. Cross. Very difficult actually, because you've got well, there's quite a lot of price action in and around these areas, and that'd be down to 50 there. So yeah, you could see it looking at historical price points there. So we've got to factor in a revenue decrease, haven't we, if we're going to do any future net present value analysis. So where is it currently? 7, so we're on the high end. Dollars a barrel. So what is that? What's have anywhere between 11 to 23 or 24% drop. Wow. Right, let's just do a quick calculation on the old graphic calculator. You could be, at worst, you just based on the fact that the oil price is dropping, so your revenues are going to drop. You could end up with 300 million on a 24% drop. 300 million in revenues easily, couldn't you? A quarter of the revenue's gone. So from a conservative valuation perspective, surely that's what you've got to use, right? Worst case scenario, 300 million. What is the historical most recent multiple that it trades at for, what are we going to say, 5, 4, 5? I know it's different on the free cash flow, but it's varied wildly. And it's very difficult actually, because net present value is done on a free cash flow basis, but the EBIT multiple seems to be a lot more stable for so 139 share, which is where are we now? We're a lot higher than that. 513 to 18, so it's overvalued. That's if you were to have those revenues discounted into the future, 5 years, sell the business for a multiple of what we've used is conservative average down there, 4. discount rate of 7.3%. Like I said, I need to learn a bit more about the discount rate because I do it based on what I've seen Joel Greenblatt use, Klarman uses, Buffett and all that. They all say not to go too far above the risk-free rate of the 10-year Treasury. So what we've done here then is we've assumed no growth on 300 million into the next 5 years. That's conservative, right? We know that it's going to drop from 400 million. We don't know, all right, but it appears from the estimates that it could drop, and you could lose up to 25% of the price of a barrel of oil. So lose 25% off the revenues down to 300%. Got discount rate of 7.3%, and then from the Dando investors' perspective and Monish Babrai, we've then used a discount rate of the 7.3%. Let me just check what the blooming 10-year yield is a minute, because that could even be wrong, and then that's not going to be what a current US 10-year come on 4.5. Oh, so we're not too far off of it. 4.5. So you'd have to change that to 7.5. All right, 3% above that. Well, 7.5. Historic margin, simple free cash flow margin, averaged of around 12%. They seem to be a lot better actually in recent years. They improved their margins from that perspective. So after 5 years, you would get and here present value there. So sum of almost 200 million plus 4 times multiple of year 5's cash flows to sell the business in year 5. So that would be another basically 100 million. So you've got 300, just under 300 million divided by the current outstanding shares, which actually seem to be increasing significantly. But then if they're making acquisitions, some of it's probably equity, not debt. Based on that, you're getting 13 to 17. So 17 would be the 10-year free cash flows and multiples. So we're looking at a company potentially that is overvalued. Yeah. Oh, wow. Yeah. Looking at some of these other ones, you're looking at a company that is going to be reasonably stagnant in price. The only thing you've got is a dividend yield, but then that could drop if the revenues are estimated to drop. If the cost of the oil is estimated to drop by 25%, then I can't see them being able to sustain a dividend that's that high. Let's just go into their on the proxy. Go in here. One. I always used to open up the interactive data, the small one. Hang on, let's go back and show you. This one here, just to get it up. Get all your stuff up fast. But in recent years, talking like I've been doing this for years, I haven't. Recent times, I've started just opening up the actual full document. I just feel it's a bit easier to search when you want to go through it. Long-term debt. What is their long-term debt? Senior notes, 160 million. Total senior notes, 150 million. Current portion of long-term debt. They were stating, weren't they, that could increase. Provides a credit facility of a borrowing 400 million. So they've got a rolling credit facility as well then, by the look of it. As of March 25, Swiss Bank, certainly there's down here I'm reading. Yes. So it looks like they've got a credit facility as well. Yeah. Outstanding borrowings, 99 million available under the borrowing base. So they've not used a lot of it in March 2025. We're obviously now past that. Interest expense, total interest expense, 6 million a year. Oh, this quarter, sorry, 6 million in a quarter. So what have we got that as over the last 12 months? Interest expense share, $1 a share. ETM interest expense, 22. Yeah. Cash flow, 118. I mean, they're more than covered on the debt side of it. That is very good. They're quite a financial, from a debt point of view, they're quite a financially stable company. It's just that if you want, my opinion is that if you want to value something as a value investor, you need to do it as conservative as possible. And then if it still looks cheap, then that's when you know that you're onto something. Whereas we've done some pretty damn conservative valuations here, and we're saying that it's overvalued. So to me, past that, you're sort of looking at guesswork. Now, this, you know, if anybody ever watches this and then wants to comment on that and explain how they do it, obviously I'm more than willing to listen to how other people do it. I am completely inexperienced. I don't know what I'm doing. This is all a very, very new thing to me. I've never built a portfolio. I'm literally going to try and build one in real time now. So if anybody else wants to turn around and say to me, you're an idiot, you're doing it wrong, please do. Yeah. But my perspective is, right, that I'm a value investor and I want conservative assumptions, and I want to know that even with the most conservative of assumptions, I am in a good place when it comes to price. Now, I'm probably not going to find a lot to invest in, but then potentially that is what Mohnish Pabrai, Joel Greenblatt, Lee Lu and all that are in. That's why they only find 2 or 3 a year, because they're potentially looking for stuff that is wildly undervalued, which I'm guessing from my approach is what I'm trying to find, and that's not going to be very easy to find. But another one, we've learned a little bit about a company we can take forward. Not really something that I'm overly enamored by, to be honest. Balance sheet, property, plant and equipment, $1 billion. Okay. So most of that is long-term debt. Yeah. Problem is, right, you're not going to be able to sell this at 100% of the price, are you? Drilling rigs and all that, drilling platforms, if you've paid, say you bought one brand new, you're not going to be able to sell it for a brand new price. So you'd have to take a discount on that. If you were to do a liquidation analysis, I don't know what a second-hand drilling rig would be like. Let's see if what would second rig for the Permian Basin sell for? I might spell that wrong. Doesn't matter. They probably won't know. If it does know, I'll be very surprised. Oh wow. When new 7 to a rig. Yeah, see, so secondhand there's huge loss in cost there. 2 million from 18. A lot of that property, plant and equipment. Does it say how many do we know how many rigs, REPX Probably do. It's probably going to be in some of their statements. Does not own any drilling rigs outright. According to the latest SEC filings, the company contracts all drilling services from third-party rig operators rather than owning or maintaining its assets. So, what makes up its assets? This is probably something we should have done early on. We skipped this part. There you got to start on the balance sheet and then skipped it. Nature of the business. Okay. Where am I going to find that? There's going to be a note on the balance sheet for plant and equipment. Other problem. Got one. Though it doesn't look like they've got anything for notes. Okay. So is there property, plant, and equipment literally in the land that they own? Yeah. Well, in that case, then that's probably a reasonable. You're not going to take a loss on them. This is where you got to start. See, I should have started on that. That shows my inexperience. I mean, I feel like we've gone to a suitable place where it goes with regards to cash flows being conservative about the long-term future compared to what everyone believes that rates are going to be. But from an actual underlying business asset point of view, we completely skipped over that, and that's not good. Which I said, it shows my inexperience, really. Oil and natural gas properties are summarized below. So 860 million accumulated depreciation, impairment, okay. Work in progress, improved. So they got over a billion improved. So if oil's worth less, I guess the land's going to be worth less, right? This is an assumption that I'm making. Have a look. Does the price of oil-rich land decrease? This is going to be a very stupid, because it's quite obvious, I would imagine. Does the price of oil-rich land decrease when the price of oil decreases? Yes, there you go. And not always in a linear or immediate way. Oil-rich land is valued primarily based on the expected economic value of the hydrocarbons in the ground. So when oil prices fall, land becomes less valuable because per share profits shrink. That's what I thought. Fewer wells are drilled. Yeah, makes sense. Reserves become uneconomic at lower prices. They exist, but they aren't worth extracting. Right. Buyers discount the land's value due to greater risk or longer payback times. Yes. If WTI is $90 a barrel, Permian acreage position with 100 horizontal wells might be valued at $20,000 to $30,000 per acre. If it falls to $60 a barrel, the same land might drop to $8. Cool, that's a significant drop. Yeah, I suppose if break-even costs rise or investor sentiment weakens, so that's a hell of a drop, right? If the price of oil drops, ChatGPT is telling us that, what's that? $30 drop, 30%. Am I right? I don't know. Can cause a 50% drop in the price. Wow. Timing matters. Land values lag behind oil price changes. Sellers often hold firm on asking prices longer than buyers are willing to pay. Yeah. In downturns, mergers and acquisitions slow because bid-ask spreads widen. Buyers priced in lower oil, but sellers didn't want to accept steep discounts. Yeah. Other influences on land value: oil price, drilling inventory, operating costs, infrastructure. Summary: yes, lower oil prices tend to depress oil-rich land values, especially in areas like the Permian Basin where value is tied to the future cash flow from development. However, the decline is influenced by multiple variables, and price adjustments often lag actual oil market changes. Would you like to do a case study of land sales in West Texas during a down cycle? Look at specific acreages changes. Yeah, show me. It's going to be a real-world example. This is why ChatGPT can be very good. If they actually pull stuff out, there you go. Dropped nearly 50 to 70%. Wow. Land prices, drilling rights in Permian fell 67%, dropping $24,000 to below $8,000. Wow. Mercer capital analysis, median cost acres in was $20,000. halved. Jesus. But the price of oil absolutely collapsed, didn't it? That was during COVID. Absolutely collapsed. Didn't it go to negative? Am I right in saying that? You could get paid to have oil taken off of you, like they were paying to take it off of your hands down here. No, not quite. Maybe it was that Brent. I'm sure. I feel like one of them. That was. I have got. No. Sure, it went negative. Got a BCO, Brent crude. $18 during COVID. Okay, maybe it didn't. WTI. Close. Very close. Okay. So it didn't. That was a lie. But that was a significant drop, right? $60 down to basically nothing. There was some huge money to be made, man, wasn't it? I wish that I was active back then, because there was some huge money to be made. These oil companies and all that would have absolutely fallen off a cliff because of the fear of this. And then look what happened post-COVID when the world reopened again. What a time to be an investor, right? If you were smart and you could see the panic, which is not many people, same as the housing crisis in 2007, only a handful of people ever actually see it. If you did, wow, fair play to you. So where were we then? Looking at this, October 2020, half to 10,000, 49% decline. So their proved land could end up being potentially historically worth like half of what it's worth now. Depending on when they bought it. I don't know if it says when they bought it. Asset derivatives. Okay. All right. That obviously, if that drops, if this is where the majority of their balance sheet comes from, because it says that they lease the rigs, something I should have looked at to start with, again, inexperience. Wow. They could be severely impacted by oil price drops. Right. Let's move on from this one. Right. We made a mistake in that we didn't look at the balance sheet side of it anywhere near enough to start with. We got there in the end. That's the main thing. You know, we've learned about what happens to, and this is me learning as well. You know, I'm learning in real time right in front of you. We've learned about what can happen to the asset values when oil prices drop. Not even a significant amount. We've seen what they're saying oil could be worth over the next few years. So obviously your revenues are going to take a hit from that, which was factored into our future cash flow estimates. The book value, it could take, like I said, could take a significant hit, which means that your liquidation value, if shit hits the fan value, what are you going to be left with could be severely impacted by this. So, you know, there's a lot of, it seems like there's a lot of future risks in this this line of work. So yes, where are we? Years to buy the company currently look very good, but that will obviously increase when the oil prices supposedly inevitably get lower. It makes sense, doesn't it? We've talked about it before. We've mentioned it a couple of times. Supply and demand. It makes sense. If you're going to drill more, it's going to be worth less. So yes, from that perspective, it makes sense. that's going to affect your free cash flows, because I'd imagine that even if the oil is cheaper, the cost of drilling it and extracting it is not likely to get cheaper. So yeah, it could be a bit of a rough time in the future for oil companies. Yeah. All right. Well, we've learned something there. We've assigned some values to it. Yeah. All right. All right. We'll move on from this one, I think. What I do as well, what I will do, I've got a tracker spreadsheet here. Let me just. So if I value something, I then put it into this spreadsheet here, and then it autofills most of these, so it's not technically my metrics, but I will put what I believe a value to be, and then if it's undervalued, in there, just so I can look at it in the future. Should the price drop significantly, I can then bring it back up, and then I've got notes thing here. What's going on here? Some items have moved. Great. Where I will write a little bit of a write-up on everything that I see, and then I would take screenshots of the insider buy-in, and I would say what percent is insider ownership, and then I will ascribe a value to these things so that I have the information in the future. I will probably add repex to that, because we've gone into some, pretty decent analysis on that. Basically, all I do is I put the ticker in, and then I put a value in, and everything else is just stuff that I want to see on a quick take. Price to book, price to tangible book, price to free cash flow, revenues, 52-week high, 52-week low, just so I can have a look-see quickly to see if anything that I have looked at previously, all of a sudden, because the price is from today, it's dragged in from today. If I refresh the spreadsheet, it would be the modern, most up-to-date price. And then if I just ascribe the value into it that we have come across, so, Joel Greenblatts 5-year valuation there, 13, Monish Probly's 13. Oh, wrong one. What am I doing that there for? So I put that into the tracker down here. What would we write in these tracker notes? Because it's good to look back on this. What I will do as well is, sorry, I'm just doing something off screen here because I ran out of things to write into. So just REPX, Riley exploration, current price is 25.25. What was the insider ownership? Was it 4.7? Let's just have a look. I will copy and paste this into TradingView as well. That's one thing I didn't speak about yesterday. Is for my charts I use TradingView. I think it's brilliant, TradingView. I use Heikin-Ashi candles as well, which smooths out the any gaps in it. Although to be fair, it looks like there's consistent volume on this for it to not be a problem. But I use it just from a psychological point of view. I feel like Heikin-Ashi candles stop me from panicking because it smooths out. I can't remember how it works. It's like, is it like a 50% average or something like that of the previous candle? I can't remember. But I use Heikin-Ashi candles. I use TradingView. When I have done so REPX, when I've wrote in the tracker sheet, I will then add notes to here. So should I come across it again on TradingView, then I can instead of having to go across to the tracker sheet, I can literally just go to the notes section on here, go, oh yeah, this is what I said last time. So whatever I write in this tracker down here, I will literally just copy and paste across. So what are we going to state here? Let's just have a look at the REPX. This one, don't see what the beneficial owners are. Right. So there's 30, almost 40% owned beneficially by other partners. We'll start with that. Almost 40% owned by our funds and partners. 4.7% owned by insiders. Let's just put that into here, 4.7. What else are we going to say? Acquired new plan to drill on, which will increase capacity, but future oil estimates appear to be much lower, which will affect revenues into the future. Simple free cash flow will obviously be affected. What we're saying could be a 25% drop, could be a 25% drop. Prices. So 300 revs conservatively used. But like I said, if I'm doing that wrong, please tell me, because I want to learn. Come 300 million in. Let's just put this up so you can see what the screen is doing. Nothing. Could be 25% drop in oil prices. 300 million revs conservatively used. Multiple of around 4 used as recent historical average. Recent historical average. NPV, net present value, coming back. This is like, I mean, that's wildly different to what everyone else has come up with, but I don't know what I'm doing, so I also don't want to lose money. That's the thing. It just appears, right, that there is potential stuff time in oil ahead, right? When you see everybody else's, 13 seems low, doesn't it? What did I say, 13 or 14? I can't remember. Seems really low, but try to buy in so we has been some, it's not significant. Just copy and paste that into there so I can see it. Yeah, everyone's really big on this, right? What's the comments on that? Like the idea of gaining exposure to production, pretty unique if they can earn. Pricey, but better than average dividend yield if it holds in low. That's the thing, isn't it? Yeah, if it holds, that's the question. If it holds on lower oil prices, yeah. Just add that into the notes. Current div yield of, was it almost 7%? Almost 7%? 5.6. What was it? 150. 1.5 divided by 25.25, almost 6%. Almost 6%. So current div yield of almost 6%, which is, you know, reasonably good, but could be affected by lower oil prices. Right, that's what we'll do for now. Then I said I would just put that into here. So if I come across this one again, I can just go, oh look, I've seen that, wrote that. Let's look and see if that's changed. So moving on from that one, effectively, back to sheet here. See what see if we can find anything else quickly. Yeah, that doesn't. Kingsway Financial Services. Just put it. Yes. Bloodbath. Outside calcium Deca. Probably. I don't invest in. I'll stop saying that. I don't like the idea of biotech companies, so that is what that is. You can tell by the name. There's a lot of money in biotech, providing you get it right, but there's a lot of people that fund a lot of drug trials and all that never end up making anything from it because either the drugs don't get accepted or they get accepted and then taken out. It's, you know, you're not going to find many value investors that will invest in biotech, let's put it that way. NEGG. Bloodbath. Negatives improved cash flows, negative earnings. The last time the EBIT was positive was 2022, so a long time ago. The only thing, right, with this quick take spreadsheet is it shows up with companies that have to be good in the here and now. My worry in using it is that it overlooks companies that are in temporary turmoil, which is one reason why I've gone back several years on it, so I can see, like, all right, yes, the operating income's awful now, but what was it like? You know, what was the return on capital like when the earnings were good? Because as a value investor, right, you're going to be dealing in a lot of shit. From everything that I've read, Joel Greenblatt, Richard Pizzina literally told the students in Joel Greenblatt's class that you are going to be dealing, to be a value investor, you're going to be dealing in companies that have issues, and you need to figure out if the issues are temporary or if they are permanent. So that is the reason why I've gone back about 6 years, 5 years, 6 years on this. So because if it looks terrible today, what did it look like back then? And if it was all right back then we can dig into it. We can ignore the fact that it's terrible today, but we can dig into it back then and say, all right, can this company turn it around? So I've just got to be aware when I'm using this spreadsheet that I need to look back here as well. Otherwise, I could be missing out on opportunities. It's going to tell me that the company's dog shit, but if I don't look at it properly, I'm going to miss the fact that it used to be a good company, and then we got to figure out whether or not it can get there again. So Texas Pacific Land, that's another one, isn't it? This is that oil, another oil? Incredibly expensive. Let's The return on capital was on this one. No wonder the share price has gone through the roof. Simple free cash flows and operating earnings. I'm in hell. Cash flow is terrible. It's fallen off a cliff mine this year compared to previous. Again, TTM, quarterly, rolling 12 months. Operating income, they must have made an acquisition. I would imagine simple free cash flow to be hammered like that. Revenue's gone up. Like, put that on it. PPL, Texas Pacific Land. That. I mean, to be fair, only doubled and it's come right back down, but you know, at 2024, quick take return on capital 2024 last year there, 160% supposedly. Fine to buy the business that right with the cash that it's making. This looks great, right? All the blue looks great. The yields are not incredible. So I don't know. There's a bit of a catch-22 on that one, isn't it? Time. All right. Fund. Okay, RCG. Well, here, can't we? Then you could see me doing it while going down through. Tiny. Rubbish again, we've already looked at. What's therapeutics? Another biotech out of there. Community fund. There's a lot of people investing in their funds at the moment, isn't there? Muscle disease. Got a bit ahead of myself there. Closed-ended fixed income mutual fund. Okay. And what's this? ASAN. Work management platform. Bloodbath. No operating income. Free cash flow is only just turned positive. Right. Shen. This telecommunications. And the little bit that I know about telecom companies, they tend to be very, very indebted. Yeah, enterprise value is a fair amount higher. Range of broadband communication services, cell towers. All right. Well, I'm going to, because we're doing this over an hour and a half now, I'm going to call it a day here, I think. Don't know when the next video is going to be. Because I work shift work, so I'm just about to go on shift now, so there won't be one for a few days at least. This is going to be my only problem, I think, when I come to live stream, and it's going to be a problem as well in that a live stream is probably going to benefit massively from a consistent schedule of when the live streams are, so everyone knows when to look out for it. In my line of work, that's not possible. I work shift work, so I basically can stream or currently video when I'm off shift. So I don't work a shift pattern that fits in with the week as well. You know, it changes every week. So the chances of me ever being able to do a consistent time, unless I'm doing one at midnight GMT, you know, UK time, you know, is reasonably slim. We will see. We'll have to see, because at the moment I don't really know what I'm doing with this, and I've still got an awful lot to learn, as you can probably tell. We will just see how it goes. All right, if you have watched this, thank you very much. I appreciate it. If you could like and subscribe, we can get more people out there, more people watching. That would be fantastic. Also, right, if I'm doing stuff wrong and you have watched this, put it in the comments, correct me, all right? This is for my learning, all right? This is not me preaching. This is me saying, look, this is what I am doing. Please correct me, because I don't know and I want to learn. And as I said in the previous video, as an engineer, you learn from your mistakes. That is what I do by trade. So if I'm doing stuff wrong, correct me, and I will try and take it on board, and I will try and see the other point of view. You know, we're just seeing how it goes at the moment. We're winging it. So like I said, none of this is financial advice at all. Very, very much do not know what I am doing. There we go. All right. Thank you very much. Much appreciate it if you have watched it. See you again sometime soon. It won't be for a few days now anyway. There we go. All right. Thank you very much, and goodbye.